Now, for another important part of your trading is to identify trends. Now, the market consists of a bunch of candlesticks that form a trend. Now, there's three types of trends. There's an uptrend, there's a downtrend, and there's consolidation. Let's go through them. Like I said, three main trends: uptrend, downtrend, consolidation. Now, a lot of traders also call it market structure. So, a trend market structure. Now, a trend is a tendency for price to move in a particular direction over a certain period of time. Now, that direction would either be bullish, it would either be bearish, or it would just consolidate. Now, it can be short term. A trend can be short term, so a quick trend, right, and then it's over. It can be long term. It can take days, weeks, months, years, right, minutes even. Okay, just depending. And you get the upward trend, you get the downward trend, and you get the sideways trend. Now, like I said, I will be sharing these three types of trends and how to identify these, whether price is in an uptrend, in a downtrend, or is price consolidating. Now, for the first one is an uptrend. Okay, means a bullish move, meaning overall price is increasing. An uptrend is created by points in the market known as higher highs and higher lows. Okay, higher highs and higher lows, or HH for short for higher high, and then HL for short for higher low. It describes the price of a security getting higher and higher, higher and higher. The highs are getting higher, the lows are also getting higher. As long as higher highs are made at the peaks, okay, and higher lows are formed at the troughs, price is considered to be in an uptrend. Okay, some of you don't know what it means. A peak is referred to the highest point, while the trough is the lowest point. Okay, keep that in mind. Trading terms, uptrend is characterized by peaks and troughs reaching new highs. So, as you can see, this is an uptrend. Now, when a trend begins, it can't just be a high high. Okay, so it will start off with a high, then price will get exhausted or it will retrace and form a low. Then price will increase again and form what's called a higher high, an HH, right? Higher high. Why? Because that new high is higher than the previous high. Then price will retrace again and it will form a higher low. Why? Because that current low is higher than the previous low. Then price will push up higher, form a new higher high. Why? Because that high is higher than the previous high. Retrace again, higher low, because that low is higher than the previous low. And that's how an uptrend gets, that's how an uptrend forms, is constantly making higher highs and higher lows. So buyers are very active in an uptrend, okay, and they're the ones that drive the price higher, forming higher highs. So once these buyers are into profit, and they will close their profits if they're happy with the profits, or they take profits or get smashed, or the seller's stop losses would get hit at a certain point, then price will drive lower. It'll have a retracement. Price will get exhausted and then form a higher low before, because now the buyers are getting it at a lower price, a better price. Remember, you always want to buy high, buy low, sell high. So as soon as price comes lower, traders buy again, and the price will then continue. Once uptrend is confirmed, wait for the higher low to form alongside other confirmations, right? Fibonacci retracement, support and resistance, trend line, volume profile, whatever the confirmations are, candlestick patterns, right? And then that's when you will look for a buying opportunity. You always want to buy at the lowest price. So on the higher lows, you always want to buy on the higher lows. You don't want to buy on a high because price is going to fall down and you're gonna lose, right? Um, you never want to sell in a buyer's market. If you can see there's a clear uptrend, you never want to sell. Okay, short term maybe, but as a beginner, no, not really. You don't want to do that. Use previous high lows as a stop loss location. So when you enter a buy, your stop loss would be below the previous higher low. Trends are temporary, even if they are strong, so never risk too much on any trade. So this is a practical screenshot of price making higher highs and high lows, forming uptrend. As you can see, where those red sort of circles are, that's where you would most likely want to buy in this market. You never want to buy on the higher highs. You always want to buy on the higher lows, because that's where price is the lowest, and you get a good price, and if it increases, then you profit. Now, like I said, in an uptrend, you'll have your impulse move up. Let's say it's the starting of a trend, right? So you'll have an impulse move up and a retracement down. So this will be known as a high, because we're starting off with the trend. And let's say this is a low. Okay, so now once price makes a continuation, okay, continues up and passes this high, okay, and then you see a little retracement, okay, happening where this pivot point is. This is known as a higher high. Why? Because this now current high is higher than the previous high, hence higher high. And so price retraces, we don't know where yet. Okay, let's say it's there, and price continues back up. Okay, this pivot point at the bottom is known as a higher low. A higher low. This is because this current low is higher than the previous low, hence higher low. So we got our impulse move to the upside, and we see another rejection. And that tells us a new higher high has been formed, because it's higher than this previous high. And then we get the retracement, we get the impulse. This is a higher low. Okay, so when you identify an uptrend, you need to start looking for buying opportunities. Now, you don't want to buy on the higher highs, because price is going to retrace down. So you're going to either be in drawdown or you're going to lose that trade. So your job is to basically buy on these higher lows, because the price is lower. I mean, compared to this high at 1.15487 to this higher low at 1.14925, I would rather buy low so that I can profit more. So, that's one confirmation. So let's say you identify a bullish uptrend. That's one confirmation. Market structure is one confirmation telling you to buy. I mean, you can put things like, let's say, your trend line. Let's say a 1, 2, your third touch. Okay, it's rejecting your trend line. So your trend line is also telling you to buy. So that's two confirmations. I mean, you can put your Fibonacci from there to there. 61.8% rejection. Third confirmation. Maybe there's some sort of, support here. Fourth confirmation. And then candlestick confirmation. So that tells you to buy. So here, let's go here. Here is an example. So this is a short example. Let's say this is a high. We'll start just over here. That's a high there. Okay. Came down to form a low. So I'm going to put my high there. And I'm going to put my low here. So now, as you can see, price pushed up to this point and then got rejected. So that pivot point on top is a higher high. Higher high. Because this high, let me remove the arrows. Because this high over here is higher than that previous high. Hence, higher high. So, price pushed further up from that low point. That's a higher low. Higher low. Pushed up, got rejected. We got ourselves a new higher high. Came down, continued up, new high low. Continued up. Continued up, higher high. Retracement, higher low. Continued up, higher high. Good. Retraced, high low, and then boom, lower high, lower low, indicating a bearish movement, as you can see. So that is an uptrend. You have to look for buying opportunities over here, there, over there, over there, and over there, with other confirmations. Okay, this is a bearish movement where price is overall decreasing. So you want to look for sells. Now, this is the opposite of a bullish trend, okay, uptrend. This is where price is lowering. So the points that are created in the downtrend is lower lows, LLs, and lower highs, LHs. Describes the price of a security getting lower and lower, okay, decreasing. So as long as there are lower highs at the peaks and lower lows at the troughs, it is known as downtrend. Okay, once again, peak is referred to the highest point, trough is referred to the lowest point. As you can see, okay, price made a low, retraced back up this time, didn't retrace back down, it retraced back up because your impulse move, we're going to get into that, your impulse move right is the bigger move to the downside, your retracement is the smaller move to the upside. So price makes a low, makes a high, then price pushes lower than the previous low. Therefore, it forms a lower low. Retraces back up and forms a lower high. This current high is lower than the previous high. Hence, it's called a lower high. Price pushed further down, passing the previous low. Now it's a lower low, a new lower low, because this low is lower than the previous low. Price retraced up, retraced again, form the lower high, and then boom, down again to form a lower low. This is a downtrend. So, like I said, you want to sell in a downtrend. Buy in an uptrend, sell in a downtrend. When the lower high forms, that's when you want to sell. Excuse me. So price pushes down to the lower low. Okay. People take their profits when they sold. Okay. Buyers get stopped out, etc. Price gets exhausted. A retracement occurs. Price gets higher. Once price gets higher, you want to sell high. So once that retracement happens to form that lower high, that's when you want to place a sell. Okay, just like an uptrend, you need to wait for other confirmations like your Fibonacci, support and resistance, candlestick formations, market patterns, all of this kind of stuff. Okay, you do not want to buy in a seller's market. So you don't want to sell in a buyer's market, and you don't want to buy in a seller's market. Use previous lower highs as stop loss location. Okay, remember, trends are temporary. Even if they're strong, don't risk too much. Practical screenshot of a downtrend. Okay, so the low is formed, the high is formed. Price pushes down, lower low. Retraces back up, forms a lower high. Price pushes further down, forms a lower low. Price pushes up, forms a lower high, because it didn't break that previous high, so it's still a lower high. Price pushes down, lower low, and so it goes on. All right, with a downtrend, price makes a low, okay, then price will make a high. So I'm just going to name it a low and a high, just to indicate that it's a start of the new trend. Obviously it will be lower lows and lower highs. So once price has an impulse move, a long move to the downside, and breaks past this low, a clear break, okay, and then makes a pivot point, then this is known as a lower low. Why? Because this low is lower than the previous low. Then it will retrace up. So now in a downtrend, the retracement is going up, and form that pivot point, and price will carry on going down. Now this pivot point here will be a lower high, because this high is lower than the previous high. We'll make another pivot point. Okay, this is a new low, because this current low is lower than the previous low. Same, and that's how it goes. I mean, this is a lower high. So this is a downtrend. Now, in a downtrend, you want to look for selling opportunities, and you want to look for selling opportunities here on the lower highs. On the lower highs. So how? I mean, okay, you've identified your market structure, making lower lows and lower highs. So you know it's a seller's market. That's one confirmation. Again, just simple. What I'm teaching you guys is, I mean, trend line. The rejection of the trend line. That's second confirmation. Third confirmation can be your Fibonacci. Fourth can be candlestick. Fifth can be some, support and resistance. So that's basically, an example of a downtrend. Now, here's a practical example. I'm going to continue from the example that I gave, in the uptrend. So we've had an uptrend, but now price pushes up, but it doesn't go higher than that high to form a high. So it rejects from this point and goes all the way down to there. So this is known as a lower high. Why? Because this high is lower than the previous high. So this is an indication. It's not certain. It is an indication that price might be in a downtrend. But what confirmed it is this low over here. So price pushed up. Can you see it made a lower low? Lower low. Why? Because this low is lower than that previous low. So now here's a lower high. Lower high. So you would want to look for selling opportunities. I mean, this could potentially be a double top. You can see this sort of support became resistance. You can put your Fibonacci, all of that. Okay, and then candlestick confirmation. But let's carry on. Price pushed down, made lower low, lower low. Price retraced back up, lower high. Okay, little consolidation. However, price made a decent lower low there. Whoops. What am I doing? Lower low. Price then came up, made a lower, and you can go on forever and ever until it changes. Okay, again, lower low, lower high, lower low. So you want to look for selling opportunities over here, over there, over there, and over there. So that's basically a downtrend. For the last one is consolidation, or some people call it ranging. Now, for consolidation, like I said, it's where price doesn't make any new highs and doesn't make any new lows. So it generally makes, a lot of equal highs and a lot of equal lows. So this generally happens after an extended move. So a move that, is big. So a big bullish move or a big bearish move, and then you'll have consolidation, a stretch of indecision before, price will most likely continue in that direction. It describes price of a security moving sideways between two prices, two levels, two areas. Okay, remember, it's not specifically a level, it's two areas of price. Consolidation or ranging is considered over once price breaks past the support and the resistance it makes. Because remember, once it's hitting, between two levels, the top level is resistance, bottom level is support. So as soon as one of those are broken, that is then considered that the consolidation is over. Now, a lot of gurus, Forex educators, they say nothing really happens in consolidation and that you shouldn't trade it. It's very dangerous. In the paid course, I show you that the institutions trade within consolidation. I show you how to trade within consolidation and how effective it is when you trade in consolidation. Okay, to a certain extent. Okay, there's differences. In trading terms, consolidation is characterized by no new highs and no new lows, the peaks and the troughs. So, as you can see, price makes a low, makes a high, okay? Equal low, equal high, equal low, equal high, equal low. So it's stuck between this resistance and the support basically. And, price is going nowhere. So here's a practical example. As you can see, low, high, and then it forms these equal highs and these equal lows going nowhere. Right? Remember, I told you it's areas. It is not exact levels. So that's why you'll see some of them is just a bit high, just a bit low. Right? Here's an example of basically consolidation. So what will happen is price will make a high. Let me do this. Price will make a high, and it'll come down, make a low. Okay, then price will try and push up again, but make an equal high. Then price will come down to make an equal low. Now, look, it can be a bit above, it can be a bit below. It doesn't exactly have to be, because remember, you always have to think of areas instead of lines. So it's zones and areas, not exactly a line. So, it can be like come up to here, because that's basically like a zone. That's basically like a zone, like that. Okay, so let me do one here. So this is what price will do. Price will come up, make an equal high. Come down, make an equal low. Come up, make an equal high. So here's the high, here's a low. Like I said, it'll make an equal high. Then it will come down, make an equal low. Come up again, make an equal high. Come down, make an equal low. And then, let's say, so that's basically consolidation. So once it breaks out, then that trend will basically continue. So then it will, let's say it's an uptrend, then it will make a higher high, higher low, and then you would look to enter here. Okay, gurus say you shouldn't enter in consolidation and everything, but in the paid course I show you how important it is and how accurate it is to enter in consolidation and how the institutions are basically entering there. But anyways, so that's where you would most likely want to buy. Or even if it breaks, let's say below, makes a lower low, lower high, and then this is the area where you would want to sell, basically like that. Here's a little example, just over here. Okay, just grasp the concept of it. So if you see something similar, so as you can see here, price made a low, made a high, made a low, made a high, made a low. So basically, this over here is consolidation. As you can see, it broke consolidation, just exactly like the example, made a higher high, okay, came down, made a higher low. Made a higher low. And then you would look to buy in this area. And as you can see, you'd have profited big. So basically, that is what consolidation is. Now, how to identify trends? The simple method. So it can become difficult, especially for beginners, to identify trends, to identify market structure. So this method is a way to help you identify this trend. Sometimes even I personally use this way still. It's very, very effective. So what you need to do is, okay, you need to go to tradingview.com. Okay, you need three things. You need your trend line tool, you need the stay in drawing tool, and the hide icon. So here's the whole sort of method. So first you click on your stay in drawing tool, because it allows you, so you don't have to click the arrow every single time. You have the arrow and you can just continue with it. Second is to click your trend line tool. Okay, you can use your trend line tool or your arrow tool. It doesn't matter. I use the arrow tool. Trend line tool is the same thing. Okay, then third thing is you want to draw from your swing lows to your swing highs, or from your swing highs to your swing lows, as you can see in that third picture. Number 4, click on the hide icon. Okay, this will make your candlesticks disappear. Number 5, then you can now identify your market structure with these lines that you created with your trend line or your arrows. So you'll plot now, okay, lower highs, lower lows, lower highs, higher lows, equal, whatever the case might be. And then the last step is to remove those lines and then click unhide, and then your chart will look like that. Now, here is a simple way of plotting market structure that can help you. It's good for beginners. Sometimes, I still use it because look, you're not always going to get an easy perfect market structure like this, where it just makes high highs and high lows clear like this. Sometimes, you know, it's too close to each other, or it's making a high high and then a lower low, and etc. So this way will help you identify what the actual market structure is. So here's an example. You know, take a arrow, okay, and you want to put it on your swing points, your pivot points. Okay, so let's say we start here, from this low to that high, from that high to that low, from that high, low to that high, from that high to that low, to that high, to that low, to that high, to that high, to that low, to that high. Okay, so I'm not going to do it all the way. So this is when you want to identify market structure. Now, what you can do is, here where it gives your pair everything, you'll see an eye icon. Click it, and it will disappear price. So now you can just look at the lines. So what you can do is, let's say we call this a high, this a low. So now we have a higher high, higher high, higher low, high high. So obviously this is a simple market structure. You can see it's perfect market structure, higher low. But this is basically how, you know, you can practice and perfect your, you know, you analyzing market structure, higher low. And then, like, once you're done with the lines, you can just remove them. So once you remove them, you put price back, and then boom, you know, you can just set them nicely, and there you have it, market structure. So, you know, I mean, stuff like this. Yeah, here we go. So let's say we start from here, lower low, lower high, okay. So what you can do is lower low. Okay, here's a lower low. Lower low. Here's a lower high. Lower high. Higher low. Equal high. This is a lower high. See, like that. So as you can see, this is basically consolidation over here. So this is a simple way. I mean, you can just remove this. That. And then put price back. And there you go. So it's a much easier way to identify. I mean, you know, stuff like this that looks nasty, like this here. Just put your you know, your arrows on your swing points, on your swing points. Swing point, just like that. Just practice on your swing points. So that's a simple way, you know, of plotting market structure.